Welcome back to another episode of Fun Friday with personally one of my favorite people in the business, another Phoenician or someone who lives in the Arizona Valley, with myself here, founder of Impact Equity, Randy Smith. How are you today, my friend?
I am doing really well, Craig. Thanks so much for having me back on the show.
Yeah, absolutely. Well, happy you're recovering. We both got sick in January. No fun. It's funny. I got the privilege to get invited to your meetup the other day, so that was super cool. So super happy that we, in fact, got to link up there, connect with obviously the amazing people that you're working with in your community. So hopefully we're going to do more of those lunches. So if you're in the Phoenix area and you want to be on Randy's list, kind of network mastermind and have a kind of a nice conversation about what's going on in the market and tidbits. Here's a guy to talk to, but we'll get into that and way more today. But before we get into kind of the second episode, the first one is usually just kind of an introduction, some of the more boilerplate questions I like to ask most guests. We'll go through some of that, but if you could just give maybe the cliff note highlight reel of kind of your origin story to get here, just to give further context if you didn't listen to the first episode, that would be awesome.
Yeah, absolutely. So I was a sales guy, corporate America, for about 25 years. I spent two 10-year stints with very large Fortune 100, Fortune 200 organizations as a sales guy, carrying the bag, leading sales teams, setting up call centers, all things sales related for a lot of years. So I ended up actually, after I started accumulating some wealth, I started buying single family out of state rentals and found very quickly that that was not something that I wanted to scale. So I shifted 100% over into a passive investing space and did that for a couple of years before I ended up getting laid off from corporate America back in June of 22. And since I had spent so much time investing in the passive investing space, very large portion of my annual or my household expenses were actually covered from my passive income. So I decided to go all in on real estate investing and helping other people passively invest in deals with operators like Lone Star and many other great ones. So yeah, I've been doing that for about 2.5 years, and we've brought about 13 million to projects. And I primarily leverage the fund to fund model with my partnerships.
Amazing. And I want to brag about you because you did something really special and cool at American Express. You actually did the biggest partnership sign up before as well, if I'm not mistaken. Can you kind of share that story?
Yeah. So I was involved in the single largest transaction in American Express history. And it was a technology guru out of Las Vegas. He had a large exit and he had a $24.5 million IRS bill that we were able to help him process through his Centurion card so he could get 24.5 million membership reward points because he was a points junkie like I am. And essentially, the guy's flying for free for the rest of his life. So,
I
yeah,
love to
that
hear
was a
that.
lot of fun. Yeah.
Yeah, well, super cool. I wasn't gonna let you go without sharing a little bit and giving a little bit of brag there. And I just think that's such a interesting anecdotal story. It's never fun to be talking about something that went negative in your life, so apologize for doing it. But just for a
Sure.
lot of people that are out there, just kind of realize that unfortunately, if it could happen to someone who's literally doing the biggest deal in company history, it just kind of shows you, hey, is it better off to go the corporate route? Or do you build something on your own? Do you figure out what your path is? What that looks like. You might have to be cutting your teeth a little bit more to start. I think the way you've done it was really cool, where you had a very successful, robust personal career, and then you obviously build a lot of relationships. You're obviously a little more credible. It's kind of tough for someone like me with a touch of a baby face who's only 30 to tell you, hey, I know all these things and I've done these things when, quite frankly, your professional experience is basically my full life experience. But super
Sure.
cool. And it's just kind of an anecdotal theme here. Sam Silverman, obviously, with his group, kind of talks about the framework with, kind of building your own businesses and stuff. But it really just is a good story there that, unfortunately, people are not always safe, even when they are thriving, killing it, and bringing a ton of revenue for the company.
Yeah. No, I think it's such a great point. A lot of people don't realize it, especially in the sales arena. And Sam, as you mentioned, Sam mentions like you've got amazing career security, but you don't ever have job security as a sales professional. And I was actually let go in a layoff two different times in Fortune 200 or Fortune 100 companies when I was at the top of my game, both times. So it doesn't matter how good you're doing, how many awards, how many accolades, how much recognition you get. If corporate America decides they're going another direction, you can be gone in a heartbeat. So
Which is crazy to me because like you'd be such an asset. You could be a manager, you could be a salesperson. Like you are as good of a person and good as a human being as there gets. And I'm not just saying that because you're a partner and I'm trying to butter you up. But in all sincerity, like I've spent enough time with you to know that you are as ethical and as honest and as good as a person as it gets. So it is their loss that it didn't work out. But obviously, you found a new path and are thriving in that. Obviously, in a very quick period of time. And it's
yeah,
funny, just to go to the single family story. I spoke with a very good buddy yesterday who actually relocated from the Bay Area, moved to Phoenix, Scottsdale. He actually got involved in this equipment financing company. He was crushing in brokerage, then started doing that. But long story long, he was starting to invest in single family real estate. And he's got about like 5 rentals he's bought now through kind of some different channels, whatnot, doing very well. But he's like, yeah, man, like I'm starting to kind of get over the single family thing. Obviously, it's a great store of value, but it's just hard to scale. So funny that you have that experience. And he's
yeah,
obviously a multifamily guy, so he's very smart, but he did go the single family route for some of his investments. But I think moving forward, you'll probably tailor his route slightly different. But you can get some really good value in single family, but very hard to scale. So not as
yeah,
much of a cash flow play, probably more of an equity lift play. And then we can go into the investment vehicles when you have that equity that obviously you raised for. But
yeah.
let's just talk about, real quick, what are you raising for right now? Because I'm sure the conversation is a skosh different today than what it would have been, right when you started, just because the cycle is different, the rate environment's different, how to make money today is different than it was, a couple of years ago, because we are in an ever-changing environment.
Yeah, so good question, and it very much has changed in the last 2.5, 3 years, as anybody that's listening to this podcast knows. But it was very much heavy value add with floating rate debt. When I first got into the space, we were seeing quick turns. Sometimes as quick as 15, 18 months, we'd see deals go full cycle, and that very much has changed over the last couple of years. So I am now focusing on light value add, certainly newer assets that are usually in the late 80s, 90s vintage, lighter value add, generally having 5 or 7 year fixed rate debt is what I'm focusing on today. So that is probably 80% of the deals that I do fall into that arena. And then I also have usually one or two other offerings. Now I currently have a debt fund in partnership with a very, very large operator, DLP Capital.
They're
They're
great. Yeah.
5 billion AUM. So they're a big, big shop, really, really great leadership team. And this is just a simple cash flow play that pays our investors around 8% monthly or 8% annualized in monthly distributions, and it's liquid. So it's a really good option for people to hold I would call it their short to midterm capital that maybe they're sitting on the side for rainy day, or, adding $2 that'll ultimately go into longer term investments like you guys offer at Lone Star.
Yeah, it makes a lot of sense. It's a placeholder. It's kind of mercenary dollars. I think it's interest income, right? So for those who don't
Yep.
know, that will get taxed at your active income clip. So, if you're making $1 million a year, call it as a round number, well, just expect to be treated in the same tax bracket. If you get into multifamily, of course, you'll get treated differently with cost segregation studies. Speak to your CPA, of course. But that
Yep.
said, it is placeholder capital. It will give you a nice return. It's not probably a forever home, but it's probably a piece of your portfolio. If let's say you've got $10 million you want to put into alts, you definitely want to have a sliver of that in, probably really good operators like DLP with Randy and such that can
Yep.
help you give kind of that cash flow ability there with good liquidity as well, because naturally multifamily deals, as a lot of people have learned, unfortunately, are not as liquid as maybe you'd like them to be, right? So,
Yep.
and then as we go to the multifamily side of things, which is kind of the bread and butter and kind of the bulk of your raising, what are the metrics you're looking for now? Obviously, you said light value add, but what are the cap rates that you're looking for, the markets that you're raising in, kind of stuff like that?
Yeah, so I'm a Smile State investor, so I like the Sun Belt, but then also starting to edge up the sides as well. Um, Even starting to look at some of the mountain states as well, but primarily I am in Phoenix, I am in Texas markets, I've done some Florida and Carolinas, and I will be likely doing something up in Denver or Colorado as well in the near future.
Yeah, and I think Colorado is really great. It's interesting because it's like really one of the only blue states nestled in there.
Yep.
Obviously, it's got tons of population growth, really good jobs, a lot of good lifestyle out there, good enough colleges, right, to attract solid talent.
Yep.
A lot going on there, but it's a little blue, but at the same time, there's a lot of upside there because there is such a great growing population. Is that kind of how you look at it as well?
That's it exactly. Yeah, and
Yeah.
I think as you guys probably talk about here, like 9 times out of 10, the very first thing that I'm looking at is operator. I want to make sure that I'm partnering with the right operator, and anybody that knows the space knows that you can take an average deal and put a good operator on it, and it can be fantastic. You can take a fantastic deal and put an okay to less than okay operator on it, and they can blow it up. So I'm first and foremost always looking for good operators like yourself, and that will drive a lot of the decisions with the other metrics that I'm looking at.
Yeah, most definitely. And it's also just to caveat the operator conversation. It's a big one. Um, Really goes back to show if you have the same deal and you give it to 10 different operators, I've said this so many times on this show, you will get 10 different results.
Yeah,
So that's kind of the, art and science, item, the delicacy that you balance when you get into the investing space, because how do you differentiate, really good marketing from a really good operator? Some of the best operators probably maybe are, deficient in the marketing bucket, right? Wouldn't that be
absolutely.
great to find? And then you probably got some of the best marketers, the cool, gadgets, the gizmos, the videos, the this, the that, which we try to do, but we also want to balance it with operating.
Sure,
All that
sure.
stuff, sales and marketing does work, in fact, but how you distinguish those things is tough. And then let's
Yeah,
get to the vetting conversation. Obviously, conversations are totally different now than they were, when you started as well. So, how does
yeah,
your vetting process change, with the market ebbing and flowing?
yeah. I would say probably the biggest change to my due diligence process that I have brought into that due diligence vetting is that I am asking to see most recent investor updates for all of their portfolio. And one, I get to see the level and professionalism of their investor updates. But two, I get to see the story on what's really actually happening with their current portfolio. There's a lot of operators out there today that are raising new capital, and yet they have a portfolio that is really, really struggling. So I have some concerns about those operators that, yes, these are all individual LLCs and legally and from an accounting standpoint, they're held separately. But I have some big concerns about deals that could be going upside down because just think if you're an operator and you've got 10 deals and two of those go south, you're having some sleepless nights. And those
And your
sleepless
eyes
nights
off the
are
ball of that new deal that you're doing, right? Because listen, we're
exactly.
all human. There's mind share, and
Yeah.
unfortunately, the body focuses on the negative. And also, quite frankly, it probably is your biggest issue if the property's going under. You kind of need to mind that business, right? So,
Absolutely. And like at a minimum, they're not optimizing 100% what they could be doing with the new assets if their attention's being pulled somewhere else. Generally, what we see is like you guys, it takes a couple of years to stabilize an asset. You go through your value add process. And then the final 2, 3 years are really just kind of coasting and refining and improving operations to a
or
certain
wait, yeah,
degree.
waiting for the market to hopefully get a little cap rate compression. Maybe you do the plan, and hey, the market's gangbusters, and you exit early, which kind of every deal that sold in 2021 and 2022 was really right.
Absolutely. Absolutely. So if you take essentially those deals, the problem deals, and you bring a lot of that energy and effort into the current day, that's going to keep your attention ultimately off of those really, really important couple of years when you're bringing on new assets. So I'm spending a lot more time looking there. Of course, my due diligence process, it's 100 plus questions at this point. It's ever evolving and changing. But that's really where I'm focusing is how's the current portfolio doing? Because you can't pistol whip the numbers, on current assets. You just can't. So
Yeah, and then what's the time aspect look like for someone you work with? I mean, how long do you have to know them for? Do you feel like you have to meet them in person? Do you need like a referral, a reference? Like inside of the mind of a capital raiser, capital allocator like yourself, fund manager,
yep.
how do those things go? Because there's some people like, hey, I need to know you for like 2, 4 years. I need to be business for X amount of time. And hey, I'm just not going to get jump into this, right? So how does that
Yeah.
kind of equate for you?
I think it's a really good question. And I wish I had a hard and fast rule for this. What I'll share with you is when I've moved quicker than I normally move, I have actually ended up regretting that I moved as fast as I did. And I'm struggling. Like I'm looking at a handful of new operators today, and they've gone through my due diligence. They check all the boxes. Everything looks good. I've gotten referrals from other people that have invested with them for a long time, and they've personally invested or they've been referred to them. Um, but inevitably, I like to sit on the sidelines and watch people just to see how they show up over time. These are long-term relationships. They're, at a minimum 4 to 5 year marriages that you're jumping into with these people. So even the best deal in the world, if you just don't like the people you're dealing with, that's going to be a really long 5 years. So I don't have a hard and fast rule that I'm following. I will say that that is evolving over time, but I'm not a guy who meets somebody at a conference and then is throwing money at them in the next 30 days. I'll just share
Yeah.
that.
Yeah,
So,
that's fair. And I'm always curious to know. I mean, maybe sometimes there's a deal that's so undeniable and it's a really reputable group, or maybe it's some really young entrepreneur, you're an entrepreneurial, hustlers that, hey, I don't have this long track record, but maybe they did find gold, and it is possible. It's rare, but it is possible. You just never know, right? Real estate's a funny business. I'm a
yep,
firm believer in this kind of concept where somewhere, some place in this country, someone just found them a deal that made them $1 million or whatever it may be. Someone just struck gold
absolutely.
any point in the
Yep.
market cycle. They got really fortunate because luck, timing, and forces of that nature all worked out. Now rare, now that maybe
Mm-hmm.
more unicorn-esque, but that doesn't mean those opportunities don't jump on your desk from time to time, right? So just something to think about there to caveat.
Absolutely.
Yeah, switching gears. Obviously, a theme of this is what's changed. What are some of the lessons through this kind of part of the cycle that you think you've learned that will maybe shift your thinking and focus to maybe just looking at the world differently, maybe more skeptically? Just how has your mindset shifted during this part of the cycle? Which I don't know. Maybe we're through it. Maybe we're all the way through it. Maybe there's light at the end of the tunnel, and we're almost out of it. Maybe the treasury market might indicate there might be a skosh more of pain left. But how do you kind of think about what you'll do differently, and the lessons, I guess, that you've learned?
Yeah, well, and I think one of the big lessons I learned was from Rob Beardsley. I heard him possibly on this podcast or somewhere else where he said the number one risk in this space is debt. And sure enough, the deals that I'm an LP in, because I'm an LP in 25 projects right now,
That you're
over
personally invested in, not partnering on, but just as a personal level, your dollars in deals.
exactly 25 LP positions, well over half of those are paused. I've got a handful where I've received capital calls, and there is likely one, potentially two, that are going to be total losses at this point. So all of those that are struggling right now are because of the debt that was put on those deals. So I I know there's still a lot of people that are still using floating rate debt out there, and I think in the perfect situation that can still make a lot of sense. But I have been burned so many times in recent years that I'm a fixed rate guy now. I like the 5 and 7 year fixed rate debt loans. And generally, I'm not looking at any deals that are using floating rate debt anymore, even if it's just going to be a 2 year project or a 3 year project potentially. So that's a big shift. Um, and obviously, I think track record, when I came in, I was really, really focused on how many deals have you done? How many full cycles have you done? But now I'm looking for full cycle, and I'm also looking even more so at kind of their tenure in the marketplace as well. So not the guys that have just been around for 4 or 5 years. Like I want to see people with 10, 12, 15 years in the space. Nice that Lone Star has relative influence of folks that have been around for decades and decades. So that really, really adds to your
Right.
value. And you guys got a bench straight of some amazing experience. So there's not a lot of operators that have 15 and 20 year track records. So you've got to
We all
dig
can't be
in.
Jason Post.
We can't. Well, and it's funny you mentioned that name because that's a group that I work with, as you know.
Yeah.
But you guys have stuck pretty close to those guys and learned quite a bit from them as well. So I think it's important to have mentors, to have people that you can lean on to kind of take advantage of their experience and strengths as well.
Most definitely. And it really is a community. And, I think whether it be with talking with you, your feedback, we want to be as humble as possible. So it doesn't matter if it's your feedback or someone else. We really do take it to heart and appreciate working with such great partners like yourself, and looking forward to only working with you more as time goes on, and being maybe one of the rare exceptions that doesn't have a decade experience just quite yet. With that said, let's talk about maybe how your endeavors will change capital raising, and maybe some of the strategies you've had with regard to kind of working with some other people to create nice large checks and maybe help some people that
Yeah.
maybe wouldn't be able to get into capital raising if it wasn't for maybe some additional support and firepower like yours.
Yeah, no, and thanks for bringing that up. Something I'm really excited about right now. Really, over the last probably year and a half or so, all of the projects that I've been doing, I've been bringing additional capital raising partners into our funds, and this brings a lot of value not only to the operators because we're bringing bigger checks, which gives us the ability to ask for better economics, but it also gives newer capital raisers the ability to start raising on deals because when you first get started, you really don't have any idea whether you can raise 500 or $1 million.
No.
So if you partner with somebody like myself or someone else that's doing something similar, it's pretty easy for you to feel confident that you can bring $200,000 or $300,000 to a deal. So if I bring two or three other partners onto my deals that are bringing 200 to 300 grand a piece plus my $500,000 plus, I'm starting then to bring $1 million plus. We did a deal for $1.5 million last year. And ultimately, my goal is to get to that point where I'm bringing $2 or $3 million to a deal. So that has really been a shift in my business. One, it takes kind of the burden off of me of having to bring everything and hit that number myself. Two, it gives me the ability to put more deals in front of my investors. And then three, it's helping newer capital raisers as well. And to kind of parlay with that, I've started doing some coaching and both in a group format or one-on-one, and it's giving me the ability to teach and coach new capital raisers. And I essentially get to vet them over the course of 6 to 8 weeks while we're going through this either one-on-one or group coaching environment. And at the end of that, I'm able to then bring those people on and partner with them on future deals. And we just finished our first deal where we announced the closing last week. I was able to bring on two partners. They had their first successful raise in partnership with me, and everybody wins. The operator gets a bigger check. I get to make a few bucks with fund administration, and I also get to help the new guy who's getting into the business.
Yeah, I mean, fund administration is really not cheap. So, for everyone to kind of get a cost subsidized, there's no loser in that endeavor. It's collaborative. And then obviously, if your coaching business is great. And let's just talk about that. Who is it for? What are kind of the principles you're teaching? Because, this business, there's not really hey, I'm going to get a PhD in capital raising or, commercial real estate, right? Particularly
Yeah,
for those maybe aren't necessarily in the business of selling, commercial, right? It's just, I wouldn't say uncharted waters, but there's a lot of groups out there that can be helpful, but it's just tough to know what's right and wrong, left, right, up, down, right? So can you explain once more who's it for and, just anything else that the group covers that, the mission of it?
yeah, absolutely. So I'm calling it the 5 steps to 500,000. It's the RAISE strategy. It's an acronym, RAISE. The R stands for relaying your message, your story to your target investor avatar. So we spend a lot of time really helping you refine your story that you can use for all of your marketing materials moving forward. We actually create specialized bots that people can use to create marketing content. And then we help them really refine their specific target avatar, which is generally just a previous version of them. Okay. In the A section of this, we help them attract through social media and specifically LinkedIn. So I teach them about LinkedIn automation for connection requests and then a lot of best practices around LinkedIn. The I is the due diligence process and identifying partners, not just the operators that you're going to raise for, but also the partners that you're going to do business with, maybe partnerships in funds, partnerships in your LLCs. So a lot of the best practices around that. The S is the structuring your raise. So we talk all about fund to fund. We talk about syndications, blind funds, customizable funds, even simple promissory notes. There's a lot of people that are getting started, and the easiest thing for them to do to raise capital is just use simple promissory notes to do some of their own projects. And then finally, it's the E, which is engaged through CRM, email marketing, and investor portals. So essentially, we cover everything from soup to nuts, everything they need to know to get started. And ultimately, it's a program that'll teach them how to raise that first 500 or a million, which can bring $50,000 or $100,000 in income to a fund manager. And it's really competitively priced. And it answers this piece where there's all kinds of masterminds out there and there's all kinds of really expensive coaching, but nothing really helps you hold your hand through your first
I was
raise.
thinking that is literally the hand holding process, which is really honestly like very cool. And I think is for those who are getting into space, like very valuable because it's like, okay, You can watch the modules, which are great. You can kind of be a part of, a really great mastermind. We're part of several. You're part of several, obviously.
Yeah.
We love them. But, we're kind of, the people that are experienced. This is our day to day. This is our life. For a lot of people, this is a really sweet extra way to supplement their income, to do
Yeah.
this above and beyond what they're doing, maybe find a path to full time do this after, a course of 5 years to a decade,
Yeah.
right? Maybe there's a career shift or a life happening event like you experienced that maybe it's like, okay, cool, this is the time to take the training wheels off and do this. So
That's
to
it.
actually have, live reps and see how a pro does it, who's very well respected, is super crucial. Also, you don't want to get a raw deal. And, I think
Yeah.
working with somebody like yourself is really going to help them avoid any pitfalls or troublings, because you've maybe experienced it yourself, or, have gone through the trial by fire there, if you will.
Yeah, no, I think that's it. There's like last week at our lunch, there was a guy sitting at the table that spent $100,000 on systems and tools and masterminds, and he's not raised a single dollar. And it kills me to run into those people. I joke, like, there are a dozen different $10,000 solutions for every $1,000 problem that you have. And there's just this gap in this space, which I think my coaching solves. So
It really goes back to not what you know, but who you know, right?
exactly.
Yeah.
Exactly. Yeah. So we're finding it's really two different avatars. One is kind of that new guy who's just getting started. But secondly, you mentioned this earlier, is there's these operators that they're truly operators, and they're not sales guys. They're not capital raisers, but they love the business of operations and asset management, but they haven't professionalized their capital raising efforts. And I can generally bring some kind of unique one-on-one coaching to those folks that really help them professionalize as well. So
Amazing. And I know obviously you've got a lot of success in that so far. You've got a lot of clients, people that we actually are speaking with as well. I think you're going to be connecting with one of them at dinner at our event at Ocean 44, which we're looking forward to taking out some of our capital partners there. So he's a buddy. I won't say his name, but I'm sure you know who I'm talking about if you look at the invite list. So super
sure.
stoked that he'll be there. He said he's excited to meet you in person. But do you have any space for anyone right now? Because I know you at one point you kind of hit your capacity. You were looking through that. So is there any availability for anyone to kind of get some of your services right now?
Yeah, absolutely. I'm doing a weekly group coaching environment where really anybody can come in and join that session. That's going to be a revolving 5 sessions that will just keep going over and over. I suspect there will be a community function to this at some point as well. We haven't quite decided what that's going to be, but I do still have a couple of spots left open for the one-on-one coaching as well.
Incredible. Let's talk about kind of final subject here, which is just investor feedback. Your job is obviously talking with sponsors and talking with investors, right? So we kind of know the sponsor side of things. We discussed that, but what are your investors seeing right now and experiencing? Because I think it's super interesting to kind of get inside of the mindset and kind of the psychology for if you're kind of a capital raiser, if you're a sponsor on that side of it, and also if you're just another investor who's curious to know what other people in the space are thinking, from their experiences right now. What would you say the state of mind is for a lot of people?
Yeah, so I think you can really break it into two different avatars. Again, you've got the newer passive investor who's just coming in. They're trying to get educated.
Aren't
And
they
I
lucky to
think,
get in now?
I do. I think they are coming in at the perfect time because they don't have a lot of the baggage that some of the other passive investors have. So they're excited. They're learning. They're actually coming in at a time where people are very cautious. People are very concerned and scared. So they're coming in, I think, at a really good time because the deals are much better today than they were even just a few years ago. So you've got those folks. They're excited. They're cautious, just like newcomers always are. And I think it's really important to just educate, hold their hand, walk them through every step of the phase. Bring that teacher, that education mentality to those relationships because people are going to buy and invest with people that they know, like, and trust. Right. So on the other side of that coin is you've got this group of folks that came in that they're a little beat up right now. If they're like myself, they've been investing for years. If they weren't sitting on the sidelines for the last few years, odds are they've got some deals that are at risk. Unless they were extremely, extremely cautious and only invested with people that were doing really, really conservative stuff. But odds are, as people invest more and more in the space, like, capital calls are reality, pause distributions are a reality. And I hate to say it, but losing capital at times is part of this space. So depending on your kind of risk profile and how aggressive you are in there, those types of things are likely going to happen. So I think we've got a really cautious group of sophisticated investors out there that are getting really, really good at due diligence. So as an operator, like, have everything buttoned up and have the answers and be able to spend the time with those folks. Because I think the time that you invest in those relationships over time will pay off. Maybe not for this deal or even for this quarter or this half of the year, but in the future, those relationships that you build are going to pay off in the future.
Makes sense. Final last question here. What advice do you have for investors or operators in the space right now from your perspective?
To investors, I always say spread your dollars across a lot of deals, a lot of operators, diversification across asset class, geography, business plan, vintage, and even loan type, I would say. So diversification, diversification, diversification. So most people that are very, very heavy passive investors, they will generally come up with some type of strategy of not putting more than X percentage with any one operator and X percentage with any one deal. So I think that's probably the biggest and most important thing. For operators, I would say understanding your niche and focusing on your niche. I think now is a time to really double down on what it is that you do in your superpower, and just like, try not to get distracted with all of the other things that are coming in front of you, and just become the absolute best at what you do. And that's something that's I had a leader in corporate America share that with me. Like, there is something really, really, really powerful with just being the absolute best at what you do. And if you can do that, you'll never have another need in your life, because if you're the best, people are going to flock to you over time. So that's my
Absolutely.
advice.
Yeah, well, I really appreciate that, Randy. It's always a pleasure to get to steal some of your time here. Hopefully, we can get you some potential new clients if there's a fit for all parties there. I look forward to seeing you. I don't know if this is going to come out before or after Race Fest, but if it's before, looking forward to seeing you. If it's after, it was great seeing you. For all those who want to get in touch with Randy, where can people find you if they want to invest with you, if they want to, go through your services? How can people find you to reach out, and so on and so forth?
Really, really, the easiest way to reach me is through the website, impactequity.net. Upper right-hand corner is a button that says book a call. I do spend a ton of time on LinkedIn as well. So Randy Smith and impactequity.net.
Excellent. Well, thank you so much for being a recurring guest here. Looking forward to having you once more, seeing you soon, working with you again, and hopefully the not too distant future. For all those who've tuned in this week, we really appreciate you, and we'll see you next week.